Ready?
Morning.
Morning, dude. Thanks for doing this. I really appreciate it.
Great being here.
So this is awesome. We've had so many questions with lenders. No, not with lenders, but for lenders, and specifically to me come through. And so I thought it would be a great opportunity to kind of sit down with you and connect and answer some questions for our people.
I love it, man. Coffee with Logan.
Coffee with Chris. So tons of questions. The number one thing that people are asking me is, Logan, how's the market? And so I want to relay that back specifically to you from a lender's perspective, because we've heard a lot, right? And we've heard projections over 2025, but you're seeing like the day-to-day stuff. So what are you seeing?
Yeah, it's such a general question, right? I mean, there's a lot that we can pour into that answer and into that question. You know, from a market perspective, both from a the property side, like the value of the property side. I mean, I just still see properties holding value, and that's really more of your neck of the woods. But we see it too in where we mainly originate transactions, right, in Oklahoma and the Metro Oklahoma City area. Properties are holding values, and not only holding values, but continuing to appreciate in a solid fashion. And so, to me, real estate, number one, is an investment. And I think the market is, I mean, it's still in a good position from an investment perspective. From a rate perspective, historically, rates are in a good position. From a last 4 years perspective, they are not as good as they were two and a half plus years ago. And so, you know, for folks that entered into either as a buyer or even as a realtor or lender into the market in 2020, 2021, man, that was gold, right? Like from a rate perspective. And so, you know, rates will potentially never see again. But where are they, man? We've in 2024, we definitely, a lot of people thought early on that they would be down. There'd be all these Fed cuts, and the Fed held on earlier in the year. They didn't make the cuts. And so early February, they were okay. They started to come down, and then they just shot back up. And then in September, same thing. We really started to see them come down a little bit into the mid fives, high fives for just a couple of weeks. And then the Fed kind of pulled back and was like, well, we may not make as many cuts as we thought on our rate. Fed rate is different than the mortgage rate, right? That's a big thing. Everybody thinks they correlate, and they did one time this year, but the other times that the Fed cut their rate, the mortgage rates went up.
Which is interesting, because historically, if I'm looking at that over the last 30 years, they're usually almost kind of like right in tune with each other. Right?
Yeah, they correlate, but here's what causes that. The last 2 months, so November and December, the Fed cut their rate, okay? But the reason the mortgage rates went up both times is because if you read what Powell said in his remarks after the Fed meeting, he spoke to the future of Fed cuts, and the future of Fed cuts were, well, we don't think we're going to cut as much as we are going to next year. So then people started releasing and selling off the bonds, which drove mortgage rates up. Okay, it's just the supply and demand piece. And so bottom line is this, is that rates have moved back up a little bit to where they probably were towards the beginning of the year, mid to high sixes, some low sevens depending. Where's the market? I think the market is still a time to buy now because you've got more inventory on the street. And in my mind, correct me if I'm wrong, buyers have more opportunity to receive seller concessions that they could apply towards a permanent or temporary rate buy down to solve the payment issue and get to a place where maybe a couple years from now they refinance the loan.
I don't think you're wrong at all, man. I think you couldn't be more right. I've literally done some video recently specifically talking about how right now is the best time to buy, and that's because we have the most inventory on the market. And that's not necessarily like a just drastic shift in the market, which we have seen a shift in the market, but that shift is usually wintertime, right? If you look at historicals and you look at wintertime, usually we have the majority of our houses on the market at that time, and then you hit into tax time and that kind of rolls. So kind of segueing into that, when we've got this massive amount of inventory, from a buyer's thought process, now we can go out and negotiate a little bit more.
Yeah.
super helpful when you're talking about rates and talking about temporary
Yeah.
reduction of interest rate if you can do that, or
Yeah.
permanence. And so, what are you seeing? Are you seeing kind of historically what I've seen of maybe a mortgage application tick up right now? So post election, post kind of, we're not past the end of the year, but usually past the holiday season, we usually start to kind of see that tick up a little bit. Are you seeing that already?
We definitely saw a little bit more people come out on the street in December, but I will say October, November, people really slowed with the election there, and they didn't come back very quickly after the election.
Okay.
Usually, literally, the turn of the calendar, we start to see more people on the street, and I think we will. And I think if people will that are on the fence can be relayed a correct message of, hey, you have a great opportunity to go out on the street. I mean, we've done this with buyers where we've pre-qualified them and said, hey, listen, it would cost you X to get a really significant temporary rate buy down over the next 2 to 3 years. Go negotiate that with the seller as you go look for a house and make that a non-negotiable. And they have been able to secure that and get into the house they wanted and get the lower interest rate for a 2 to 3 year period. And so now I think that's why now is the time. Have we seen applications increase somewhat? But I definitely think 60 days out from the election, people really started to pause. And they haven't fully come back, but they've come back a little bit.
So what that's telling me is we're ramping up to have a really strong year.
Yep.
And right now, the mortgage applications aren't there, meaning the buyers haven't fully come back yet.
No.
So if you are in a position to buy, or you have the thought process of, I want to get a deal, now would be the time to go out and make those deals. So I want to touch real quick just on what you just said about temporary rate reductions.
Yeah.
And so I know what you're talking about. We've done several of these, but I want you to kind of explain that a little bit of what that looks like, and kind of like what that looks like on year one, what that looks like on year two, and if nothing happens during that time, what that would look like, so on.
Yeah, conceptually, my favorite one is the 3-2-1 buy down. It's the most significant impact, and a lot of times what I tell my friends and really a great realtor partner like you is, like, when you have a listing and it's $350,000 and it's not moving at all, and the seller wants to reduce the sales price by 15 to 20 grand, and that doesn't do much to the payment for the buyer. The reason they're not showing it a bunch, not the only reason, but a large reason, is that it's a payment issue for buyers. So how do you solve that problem? You don't solve it with a price reduction, because it doesn't move the payment very much. You solve it with, hey, we're going to keep the price the same, but we're going to offer what we call a 3-2-1 temporary rate buy down, the cost for that. And conceptually, it reduces the interest rate. If interest rates are at 6.5 today, it reduces at year 1 to 3.5.
Okay.
Year 2, 4.5. Year 3, 5.5, and then year 4 and beyond would be 6.5.
Which is what you locked it at.
Which is what you locked it at.
So it's not going to go up. It's not going to be adjustable. It's not anything like that. It's not anything crazy. It's just a temporary reduction of your payment.
And it's a very large temporary reduction, right? And what it is, the cost of that is the interest saved over those 3 years. But here's the coolest part. If at $350,000 it costs 15 grand to do that, and that is a total fictitious number, that I'm just guessing. If it costs 15 grand to do it and the seller agrees to pay that, the buyer wouldn't want to pay it because you're just prepaying your interest.
Right.
If the seller agrees to pay that, then at closing, the lender will just hold that 15 grand in escrow and help subsidize the buyer's payment every month.
Wow.
Okay? And then here's the coolest part. 2 years in, the rates drop to 5% and they want to refinance. Okay? We go and refinance them into 5%. And whatever is left in that escrow, we apply it towards their principal reduction. So they keep that money.
Why wouldn't you? Yeah.
It's a great tool. A permanent rate buy down, you spend a chunk of money to get a little bit of better interest rate, and you never get that money back. If you go refinance a year later, you've spent $5 grand to reduce the interest rate by 3/8 of a point. Never get that money back. Temporary rate buy down, you always get that money back if you don't utilize it.
Massive.
So it's a huge, great tool that helps solve the problem of the seller. So if you're a seller out there, you absolutely need to be
massive tip
having that conversation.
Massive tip.
Yeah.
No, that's really good. So can you, and and I know it's hypothetical, and,
Totally.
and we're just putting out numbers
Yeah.
there, but from a savings, let's use that kind of same ballpark
Yeah.
figure of 350. If
Yeah.
we were to reduce the price to 330,
Yeah.
that's $20,000. What would that about be on a payment? Can you guesstimate about how much that would be on a payment that you would save monthly from that perspective?
I don't have an idea.
You're good.
Yeah.
Just trying to put some numbers together so people
totally.
could kind of think through that. I've seen them on paper whenever he does this for me, and it is a drastic difference,
Yeah.
The savings. And so it's almost like a no-brainer, and people just don't know that this
Yeah.
is an option. And
Yeah.
so they know that I can negotiate for them, but they don't know that I can do things like this and creative ways to be able to capture your dream house.
And what I would say, if I'm a buyer and I'm like, listen, that sounds great, but how do I know that I could actually get this when I go out and hunt? Well, you just make it a non-negotiable. Hey, I'm not going to buy unless.
Yeah.
Right? Just like you say, if you own a house and you say, I can't buy unless I sell, I can't buy unless I get a temporary rate buy down.
Yep.
So Logan, hey, I want to buy at 300, but we need to go find a house that'll do that and also provide seller concessions enough. And I can give them the number and you the number to go ask for on that sales price as you go and hunt.
That's perfect. So it's just one more reason of why you, again, have to be prepared and get pre-qualified and do all those things really before you go hunt, because if you don't have a game plan, if you don't have these kind of desirable situations that you're trying to get to, there's no way to get to them without like guessing.
Yeah, and and that's what a real consult is, right? I mean, that's what sitting down via Zoom or face to face and going through and analyzing a buyer's scenario and situation and desire for their purchase to look at and go let's make sure they match up. Let's make sure you know what a payment looks like and cash to close looks like, and do you fit all the loan programs? Logan, we were talking about this earlier. We have every loan program known to man. I mean, there's not a loan program that's out there that I can't think that we don't have. And so when we work with a buyer, we want to make sure that we've gone through every loan program and make sure that they are in the best situation possible to go out and leverage their situation and go buy. And so that they know, hey, we want to be prepared. So when we find that one house, we know exactly the right loan program, what the terms look like, and we can pull the trigger.
That's so good. And it's so important to have that just thought and mindset and capability, to be honest, is going out with my clients and having the understanding that we're ready is a game changer whenever you go to present an offer or know that you're in a multiple offer scenario, which isn't happening as much, but for those perfect houses, it's still happening, because the perfect house, it's not just perfect for you, right? It's perfect for so many people. And so if you're doing the right things to make your house perfect, you will sell it at top dollar and quickly, but it has to be perfect. And if not, that's whenever, from a buyer, you can go in and say, okay, that one's been on the market for a little bit. Maybe this is a really good opportunity to do exactly what we're talking about.
How much do you run into where you get pushback from your buyers going, I don't want to go get pre-qualified, I just want to go look at the house?
It used to be a lot.
Okay.
It used to be a lot. I think the reason for that was their thought process was, okay, if I'm going to start this process, he's going to have to pull my credit. He's going to have to do all this kind of stuff. What if that drops me? And then it's going to, all these kind of things. They don't want to have those hard inquiries on their credit. But the truth is like, the score gaps are so large that, I mean, unless if you have over 800 and it pulls you all the way down to under 715, there's not going to be,
happening.
It's not a gap change.
Not happening.
And it's not going to pull that kind of hard. It's like a 2-point drop. So I'm hypothetical numbers there. I just know it's very low. So that's the number one thing that I deal with as far as like people saying that they don't want to get pre-qualified. Now I don't feel like that's an issue, because now it's like, hey, this is a plan. This is a process. I think maybe with that August 17th, that the NAR rule that has changed some things too, because now people are seeing us maybe just seeing me more as advocates for them rather than like, well, I got to call this guy. Can they go show me the house and they're going to sell me the house and do all this kind of stuff? Well, no, those conversations are happening up front now, and so. And then for me too, I was always of the mindset, I'll go show you 2 properties before you really have to get approved. And those 2 better be really close to each other and in the same area. And let's do that to really build the rapport and make sure that it's a good fit before I go down this crazy path. And so not seeing it as much anymore. I'm sure others are, but I'm not. So.
Yeah, and the thing I see more, the conversations I'm having on a weekly basis right now are people getting pre-qualified. And I had someone ask me the question yesterday of, hey, are you seeing less people being able to qualify with rates up, insurance up, taxes
Sure.
up? And the answer I gave them was no. Like we looked at our numbers at the end of the year. We had all of the pre-qualified buyers that we had set a goal for. Like we set a goal for X amount, 375 or something like that, and we qualified that amount of people. They just that many didn't buy, or
Yep.
that we wanted. And so, but we're not seeing people struggle with qualification. What we're seeing them struggle with is, oh my gosh, I love this house. We get through, go through qualification, then we go, and FYI, the payment is X, and they're like, what? And it's $700 more than they thought a month.
Why do you think that is?
I think I don't fully know. I do think definitely not having an understanding of how rates impact payment and how drastically it can, but also insurance and taxes.
Massive.
I mean, they're just different than they were, especially insurance.
Yeah.
We're seeing a much larger increase, and so that's why consultation before massive hunting for a house is so important, so that emotional decisions aren't made. Tactical, logical, leveraged decisions are made, and it also gives us more time to allow, again, to make sure that if they are a first-time home buyer, or not even a first-time home buyer, but qualify for some sort of grant or extra, there's Fannie Mae and Freddie Mac right now are giving closing costs if you make under a certain amount. I mean, there's things that are out there for people that when everybody's under pressure to do it, reverse engineer it, that you miss it.
Yeah.
So we want to make sure that people are prepared correctly.
I feel like that's the perfect segue for me to kind of transition into kind of the grant question or first-time home buyer or any of that. So right now, specifically for me, there's a big grant that's out there and where we're at, and that's the Cleveland County grant. Can you give me some insight on what that is and who could qualify for it, since that's a lot of our customer base since we live in Cleveland County?
Yeah, and I'll just say, let me start broad and then get a little bit more specific.
Perfect.
Broad would be, there used to be this perception of, hey, what about that first-time home buyer money that's out there? And that was like early 2000s, right? Like that was like, that's not really how things are set up anymore. In general, when people are talking about first-time home buyer programs, what they really mean are down payment assistance programs.
Correct.
And the major down payment assistance programs, which are OFA and REI, all require a payback now on that assistance. They used not to, but now they do. And there's different methods of how much you get, and then how much you get paid back, and how much you have to pay back. There are some county-specific, you can call them grants. I just closed one in Canadian County where the buyer got $14,000 for closing costs and down payment.
Wow.
They didn't bring anything. They had to bring 1% of the transaction to closing. So it was their earnest money and the appraisal they paid for.
That's awesome.
So we're in the middle of uncovering the Cleveland County one. I just found out yesterday that we are finishing up getting signed up and approved for that.
Cool.
So we'll be approved for that. As soon as we finish that up, we'll be able to dig in on the details. But I do know that there is assistance. I think it's 3.5%, and I do think it's forgivable after being. So don't quote me on this. This isn't 100% gospel.
Yep.
But I think it's forgivable after 5 years, which is more like the old down payment assistance programs.
Massive.
Okay, and then there is a rate reduction. There's a better rate option. I do also think the money runs out, which OFA and REI, that's really not been the case, right? That doesn't really run out. Cleveland County, Oklahoma County, Canadian County does, and I think Cleveland County one will as well.
Yeah.
So
the Cleveland County one, I believe I read it was $25 million that they're offering as far as like grant.
But how many years and how do they spread it out? You're right.
Yeah.
So
but all that to say, there's money out there that's available.
Absolutely.
I love the OFA down payment assistance. We've used that a ton.
Yeah.
And that is one of the repayable options, but it's a 0% interest loan. And typically they give you
3.5%.
What's that?
3.5%.
3.5%.
REI is the 5% one. Remember,
That one's
that's
crazy.
a great option, and I like it because you pay it back in the loan.
In the loan, yeah.
On over a 10-year period at a lower interest rate
good.
at 5%.
So good.
So they're both great, and we do a lot of both.
That one actually saved a deal for me with
Morgan's. It was dead.
It was dead.
It was dead, and we have that program, and we're able to.
I was in Mexico,
yeah,
having a cerveza, calling my favorite lender, Chris, trying to figure out how to get my clients through this process and to the final, and we got them there on a completely different property with a completely different loan with a completely different lender, and you saved the deal. So I'm so thankful for that, and so. That's a scenario where a client comes to me and they're like, Logan, we're pre-approved, ready to go. And I say, let's go. And I ask them the question. I always ask the question, do you know this guy?
Yeah.
And if they don't know them, I'm always begging them, will you please get a second opinion? So I'm appreciative for you, man.
People don't know this. Everyone's always like, oh, it's lender specific, right? So lenders choose how low they will go. But FHA goes to 500.
Based off of the investors that are purchasing it, correct?
Not necessarily, no.
Okay.
It's risk threshold.
Okay.
And so a lot of people stop at 620. We stop at 580.
Okay.
But we will make an exception to go all the way down if there's some compensating factors and we can get approval.
Yeah, that makes sense.
So I mean, literally, I got one approved the other day for like 542.
Wow.
But they're putting some money down, and they had some other compensating. Their debt to income ratio was low, or whatever. But we got them approved.
That's cool. Okay, so let's talk self-employed people, right? So they own their own business and they want to buy a house.
Yeah.
That becomes a little bit more difficult than your standard like W-2 employee. And so talk to me a little bit about what that 1099 contractor is going to need to bring to be able to buy the house that they're wanting. What does that look like? Are they needing more of a down payment, or what specifics are you looking for?
Yeah, so let's back up and a quick understanding of why, because I get people, I mean, you want to talk about mad, like self-employed, some of the most successful people financially are self-employed people.
Yeah.
And I've worked with some of the wealthiest people in this area and not been able to do their loans because they don't fit into the box that Fannie Mae, Freddie Mac, FHA, Ginnie Mae write guidelines for from a self-employed perspective. And so to understand, when you're analyzing someone's file and when the guidelines are set up to review their history of credit and how they've paid it back, right? Their history of income and how they've made it, and their assets. How much have they accumulated? And when you're looking at income, they want to look at they're looking for predictability. Hey, we just got to know, can this person pay the loan back? And the only way we know that is how much can we see that they've made over historically. And when you're W-2, that's pretty easy because the employer is saying, hey, she's going to make X amount for this many hours a week, and we can show a history of it, or they'll put it on paper in an offer that, hey, they're going to make this. So there's predictability.
Yep.
When you're self-employed, and let's define self-employed, this is someone that owns 25% or more of a business or is non-W-2. So this could be someone who's in partnership with a business. This is someone who has an S-corp. This is someone who's just flat 1099 truck driver. Okay, well, hold on. I work for someone. You do. Are you W-2 or 1099? I'm 1099. Okay, then you're self-employed.
Yep.
And the reason is because they receive income, and then they have all of these expenses, and they write those expenses off. And so the guideline writers have to be able to see revenue minus expenses. How much does this person have left to spend on discretionary income?
Sure.
Okay, so that's a self-employed borrower. Okay, so how do we approve someone with that? Usually the guideline is you've got to have 2 years of history on your tax returns so they can see predictability.
Yep.
Revenue minus expenses equals net discretionary income. And that's how I calculate on average what someone's self-employed income is.
Okay.
And that's how much I can then put in there to say, now that's the income I can use in their debt to income ratio. Okay. So the game of self-employed borrowers for tax purposes is to what? What's the goal?
To spend as much on, or to spend as little on taxes as possible. So you're
Right.
writing things
So you're
off,
writing everything
things
off.
Right.
Okay. That goes against mortgage guidelines.
Yeah.
Okay. So those two like counteract each other.
Yeah.
And that's the problem.
Yeah.
Okay. And so, a handful of ways to handle that. What you need to know is there are programs out there for you. If you do write everything off and you have a history in that trade and you make good, consistent income and it can reflect on your bank statements, that there are programs out there for you aside from the conventional mortgage that allows you to get into a home.
Okay.
Is it easy to do that? No. Are there definite options out there and programs that we have that would allow you to get in a home still? And the answer is yes.
Cool.
Okay.
I want to scoot over just a little bit. Same subject, but let's talk about people that make commission.
Yeah.
Because I came from a world where I was salary and commission prior to being in real estate, and I know several of my clients have had issues with. Well, they make so much money, but a big portion of that is because they are good at what they do and they make a good commission. How does that play into the qualifying process?
What was the number one factor I talked about on income that they look at? Predictability, right?
Yeah.
So they want to just know, like, how much does this person make in this job? It's awesome. If you make $1 million, that's great. But how do they make it? Mm-hmm. Is it salaried? No, so it's less predictable.
Yep.
Okay, so let's throw commission in with, so you've got like a salaried or an hourly, consistent hourly income. You throw that aside. That's predictable, right?
Yep.
Okay, what's not predictable? Commission, overtime, bonus.
Yep.
Those are all what we call variable that's all variable income.
Okay.
And so they vary depending on the year, the month, the week. And so you've got to have a history of that so that the lender can go, okay, you can predict that on average they make X out of that type of income.
Sure.
Okay. So commission typically is a 2-year history.
Okay.
You average it with the current year to date. So you just average those. Now, the cool thing is conventional, and this is where it gets quirky on all the different programs and guidelines, and this is why you got to make sure you're with a lender that understands these nuances. But conventional allows for a 12-month, potentially a 12-month history if they've been in with some compensating factors. If they've maybe been in the industry before, let's say they're a car salesman, and they've been in the industry before, they were with another car automobile dealership 2 years prior, and they have that history, but they've only been with the current one for a year. Well, we can take that year that we've had and average that, but use the history as they've been in the industry, and so there's some stability there.
Only if that's industry correlated, though, correct? So, like, if they
Typically,
go from a sales position in
Verizon
to
an auto dealer.
No, okay, so they have to be matching industry.
And why is that?
Predictability, right?
Predictability.
Yeah, sure.
It's just and I think if people back up and they're not in the middle of a transaction, so many times you can, like, the guidelines actually do make sense.
Sure.
But man, it gets personal.
Right.
It gets super personal when you're in the middle of a transaction and you're telling people they can't do something. They're like, this is crazy. I'm like, well, they just need to know that you can pay the loan back.
Right.
That's all that.
Sure.
And when I say they, I mean, it's not even the entity I work for. It's the entity, the people that write the guidelines, which is Fannie, Freddie, Ginnie Mae.
And the whole reason for that is to not get back into a scenario that we were in 2008.
100%.
So it's good that these restrictions are in place because it's going to protect us from pitfalls that we may enter.
Yeah.
But the truth is that now that these are in place, you just got to kind of roll with them if you're going the traditional lending route.
100%.
The only other lending route that there is, if you're not going traditional lending method, would be kind of like a hard money loan, which is where you're usually bringing that 20% or more, and it's a higher interest rate than what your standard loans are. And so really those are the times when you're like, there's no way for me to get an option. I've got money. credit typically isn't even an option in those, right? Because they're putting so much down in the asset, or the risk makes sense for the lender in that scenario.
I don't have a ton of knowledge of that, but a hard money lender conceptually is a lender that's backed by private investors. So if Logan was inherently wealthy and said, "Hey, I want to take my money and I want to loan it to people who through X, Y, and Z company that's a hard money lender, and I want to make 12, 15% back return on investment on it, and I'll lend it for a 12-month period," then Logan would lend his money to this investor. The investor would then lend it to a borrower who has whatever issues, and so it would be a really high interest rate, shorter term, and their goal would be to flip it to conventional or to traditional financing at a certain point.
Yeah.
But yes, there are those entities out there.
Yeah.
I don't totally know guidelines
Sure.
of what they're looking at.
All that to say, guys, if you want a property, if you want to buy something, we can absolutely make it happen. Chris has every loan in the book to be able to make it happen. And so definitely a person that you can trust here. I've trusted him for the last
X years. I was trying to think of that.
Well, so I've been doing it 8 years.
Okay.
9 will be January.
Yeah.
So I mean,
Yeah.
we're almost to 9,
Yep.
and so very blessed to have you. Very
Same.
thankful for you and your relationship just with Brittany and I, and having you as a mentor has been incredible. So I appreciate you, brother.
Man, I appreciate it. Thanks for trusting us, and it's never perfect, right? That's the thing I appreciate about you. I feel like we have great conversation and banter of how do we make this better. It's never perfect. We always try to make it perfect for our clients, but I think in the end, you want to work with people that you like, and that are like-minded, and that's what I appreciate about you and being able to partner with you.
Appreciate you, man.
Thanks, man.
Sweet. I think that's great.